we're going to talk about ETFs today. But this is why our challenge is important. If you guys saw in CNBC, they put out this article today, and check what it says. It says Black Americans' lack of participation in the stock market likely to widen post-pandemic wealth gap. Yep, that's what it said. Look at it too. It was published February 2nd, 2020. So today, just published. And I want you guys to take in some of these points, because this is why what we're doing here is so important. I told you on Monday that this is bigger than you. It's bigger than just you showing up, because this is about a movement. This is about all of us on here actually helping to bridge the wealth gap by us actually getting invested. And the article tells us why this is important. So some of the key points, and we can actually put this in the Facebook group too. But some of the key points: many Black Americans missed out on the hefty gains from the stock market due to historically low ownership. Only 34% of Black American households owned equity investments, as compared to 61% of white families, according to Federal Reserve's most recent survey in 2019. The primary way that Americans build wealth and invest is through retirement plans, and there have been enormous racial disparities in that area. What I'm going to teach you this week would be a replacement, or not even a replacement, but in addition to your retirement. When you're investing in the overall market, like the S&P, the Dow, and the NASDAQ, that's similar to what your retirement plans would be doing. So this is you taking control into your own hands, even though it's saying that there's a big disparity in racial groups. And let's actually look at the article, because I think this is important. And we'll give people who are running a little late a couple minutes. But thanks to the historic stock market rebound from pandemic lows, affluent 401k holders and savvy investors in the U.S. enjoyed double-digit returns from stocks over the past 2 years, but not for the majority of Black Americans. Only 30... Somebody's like, Teri, you did not have to add the sound effects. I did. That was important, y'all. Only 34% of Black American households owned equity investments, as compared to the 61% of white families, according to the Federal Reserve. We saw that earlier. The average value of stocks Black Americans owned amounted only to $14,400, nearly a quarter of what their white peers held, the data said. And I won't read the whole thing, but just even these headlines: Black Americans being left behind. Really? That's why this is so important to me. That's why, although I am doing super well in the stock market myself, I feel like it's an imperative that I teach everybody else. I got to teach, because otherwise, how are we going to build this wealth gap? And this article, as you read further in it, basically says, look, if you guys don't start investing, you're going to be behind. The only way that you're going to bridge this gap is if you start investing. So I am proud of you. I am proud of you for showing up today. I am proud of you for being on this call, because that means that you are stepping up to the challenge. You are going to change this movement. You're going to change this disparity, because we as a group are going to collectively start investing. Anybody else say committed in the chat if you are serious about this. If this moves you and you feel like, wow, I did not know it was such a big deal, put committed, because we got to be committed to seeing this all the way through, because it's not about just us. It's about more than us. And for all the people who are on the call and they're like, well, I'm not Black. Thank you for being here. But on Monday, I saw the video of most of the people on this call. And of the 7,000 people that signed up for the challenge, majority of the people are African American. So that means that, one, I feel like this article is slightly off, because we are making a difference. But two, we are going to be the change. We are physically going to be the change for things like this. If anybody on here writes for CNBC, I hope you write an article about what we're doing today, because I feel like we are the opposite of this article. We are the ones that are committed to changing our lives and getting invested. Look here, only 44% of Black Americans have retirement savings accounts, with a typical balance of around $20,000, compared to 65% of white Americans who have an average balance of $50,000. That's $30,000 more than us, according to the Federal Reserve. Here, if you had access to a well-managed retirement plan What's happened in the last 2 years has been a boon to your bottom line wealth. But many of us, we're just starting. But I don't want you to get discouraged. I don't want you to feel like, man, am I too late? Because no, this is still a prime time. So let's get to it. In the overall market, when you go into CNBC, and we're going to use CNBC a lot here today because they show you the overall market. They show you what's going on. So here with the Dow, the S&P, and the NASDAQ, those are the big overarching indexes that we follow. And we kind of covered this at the end of yesterday, but I want to cover it a little bit more today for anyone who missed it. The Dow we talked about yesterday is the top 30 companies in the US. And when you look them up, it looks like this. And this was your homework yesterday. So I'm reviewing homework. But I asked you, look up what companies are in the Dow. So we have American Express, Amgen, Apple, Boeing, Caterpillar, Cisco, Goldman Sachs, Home Depot, all of these companies. And the cool thing is they represent different sectors. So you have a little bit of consumer discretionary, a little bit of tech, a little of finance, and all those together are the Dow 30. Are there any of these companies that you were surprised to see were in the Dow? Here are the rest. Here too with the Dow Inc. This is not, this confuses some people. They're like, wait, there's one that's called Dow. Is that the same? No, this is a company. So this company is actually a company. That's not the same as the overall Dow index. So don't get that confused, okay? Okay. But as I said, so the Dow has 30 companies in it. The other one we looked at was the NASDAQ. These are the NASDAQ 100. The NASDAQ we talked about yesterday, but the NASDAQ is it's an actual exchange, a stock exchange where many tech companies go public. And going public just means they decide that they want to sell pieces of their company. And so they ask an investment bank, hey, what's our valuation? The investment bank says, oh, you're worth this much. You can divide your company into this many shares, and each of the shares will be worth this much. That's how the initial price comes for their stock, right? And then they start selling it and they say, well, the investment bank said that we're worth this much. So if you're willing to pay this much, here are the shares. But then what happens is, if a lot of people want to buy those shares, it'll start at that price, the initial public offering price. It'll start at that price. But if there's a lot of buyers, they'll start going up in price because somebody will say, no, I really, really want to get into this. Please, how can I get into this? I'll pay you a little bit more. And they'll get it. And the price goes up. Oh, no, I still want to get in it. I'll pay you a little bit more. And the price goes up. So if you have a lot of buyers, the price of those stocks will start going up. But likewise, when people are ready to sell, that's when the stock's prices start to fall because they start saying, hey, look, I'll take anything to just get out of this. What's the lowest you'll give me? And then somebody else will come along and says like, no, I really want to get out. I will sell it even lower than that. And then someone else. So if you have a lot of sellers, they'll push the price down. Okay. So back to my original thing, though, the NASDAQ is where a lot of tech companies will come public and start selling their shares on the NASDAQ stock exchange. But the top 100 of those are together in an index that's the NASDAQ 100. So it's these companies here. AMD is on there. That's a semiconductor company. It's like the chips inside of your cell phone and game systems and computers. That's AMD. You guys know Adobe, Airbnb, Amazon. So most of the tech companies, Apple, most of the tech companies are going to show up in the NASDAQ 100. But remember that you can be in more than one index at a time. So if I come here, and I know I'm talking kind of fast, but yes, there are recordings. But if I come here to the Dow, you'll see that some of those things that were in the NASDAQ are also here. So like Apple is in the Dow 30, but it's also in the NASDAQ because it's one of the top companies on the NASDAQ stock exchange. And that's okay. Sometimes when we look at these indexes, we think, oh man, like I really wanted to be exposed to Apple, so I just need to do the Dow. No, you're also exposed to Apple if you were investing in the NASDAQ 100, and you're also exposed to Apple if you're invested in the S&P 500, because it just goes a little bit bigger each time. The Dow only has 30 companies, but the S&P 500 has the top 500 companies in the US. Okay, so those are the different indexes. Whenever you first open up CNBC or Bloomberg, if you look at Bloomberg News, shout out to Bloomberg. I was on their radio show recently, but the first thing they're going to say is the stock market is doing well because the Dow is moving, or the S&P or the NASDAQ. Now you guys know what that actually means. All right. Now the question becomes, Teri, if I want to invest in the overall market, like I want to invest in the Dow or the S&P and have exposure to all those companies, how do I do it? And that's when we talk about something called an exchange traded fund. I'm going to slow down a little bit because I know somebody is taking notes and they're like, wait, Teri, please hold on. Go ahead, get your notes. Okay, you ready? Okay. So the exchange traded fund will also look at those same companies. So let's look at the NASDAQ one more time. The exchange traded fund will also invest in these companies. It'll put AMD in there and Adobe and Airbnb in there. And then it'll invest, like it'll have a certain market cap, like how much money that it's investing. It'll say, okay, we have this much money that we can invest, and it'll distribute the money according to the same way that the index distributes. So if there's this much money that usually goes to AMD, that's how much the ETF will put towards AMD. And then it'll put some towards Adobe, some towards Airbnb. But the cool thing is you can invest in that exchange traded fund like a stock. It'll operate like one entity. Does that make sense? So if I want to invest in the NASDAQ 100, I can actually go get one share of the ETF that covers the NASDAQ 100. I could feel right there somebody got confused. So breaking it down even more simple, an ETF is like a bucket of stocks, a bucket of companies, and you can invest in that one ETF and have exposure to all the companies that are inside of it. If we invest in the ETF that covers the NASDAQ, we are basically having exposure to all the 100 companies that are inside of that ETF. That make a little more sense? Good. Same thing with the Dow. If we invest in an ETF that covers the Dow, then we'll have exposure to these 30 companies. And the cool thing about that is you're not invested in just one company. So it's a little more, they usually say a little bit more secure. And disclaimer, I forgot to say the disclaimer today. Today, everything is for educational purposes only. This whole week, everything is for educational purposes only. I'm not telling you what to invest in, but I'm hoping to educate you so you can go and make your own decisions. Do know that everything in investing is risky. So you have to take it at your own risk. But as we just saw in that article, if you don't participate, you're going to be left behind. Period. Okay. All right. So if we invest in an ETF that is covering the Dow, we'll have exposure to all 30 of these companies. So then the question becomes, for my note takers, y'all ready? I'm about to switch and tell you which ETFs cover each of these indexes. Are you ready? All right. And actually, I think I might do this a little bit of a different way. Let's just focus first on the S&P 500. So if you go to there's a website called ETF.com. And honestly, I think it's a bit overwhelming. I'm going to tell you today on this call which ones I personally follow to cover the different indexes. But I am going to tell you, because I think there's so many of us and some of you all like to do your research, how to find this yourself too. So there is a website called ETF.com. You guys see it up here at the top left? ETF.com. If you go in there and you put in to the search bar, it says search ETF.com, and you search the different index names, so like S&P 500, it'll give you a list of all the S&Ps or all the ETFs that follow the S&P. So if you come down here, here are all of the ETFs that follow the S&P 500. So you see SPY, this is a spider ETF. IVV, if you like Vanguard ETFs, VOO is one. And then all of these right here, it says the 3-month return, all of them are down, but that's just because over the last 3 months, the S&P itself has been down. And remember, the S&P actually covers 500 of the top companies. But to this article that we just saw earlier, one of the reasons why they say that we're behind is because the S&P 500 index, it was up 26.9% last year. 26.9% return just in the S&P. So that's why they're like, because Black Americans were not invested in the S&P, they missed out on 20% of growth where all these other people were growing. So these ETFs here are going to allow you to get invested and take advantage of that growth. Now, every year is not going to have 26.9% growth. The average is 8 to 10% return. And sometimes there's even negative return. A few years ago, it was negative. So you just have to know that investing comes with a risk. But the goal would be to be in it on those years when you have 26% return. And even if you're in it on the down years, it'll average out to 8 to 10%. Okay. So take a look here. These are some of the ETFs that cover the S&P. And I see some of you guys have your hands raised. You can put it in the Q&A. I'll cover questions at the end. The one that I like the most, and again, this is personal, not telling you what to do, but I like this SPY the most. And you can see it's the biggest. It has the most money under management. And even here it says there's 15 ETFs traded on the US market covering S&P 500 with a total assets of over 1,000.16 billion. That's in the trillions, right? They were like, we can't even put that into numbers. It will take up the whole screen. The average expense ratio is 0.63%. So there are usually some fees to invest in these ETFs. And then here it says the largest S&P 500 ETF is the Spider S&P 500 ETF, SPY. Okay. So if you want to invest in the S&P 500, you can potentially use SPY. Now, what do you do with that? SPY is the ticker symbol that you're going to have to use tomorrow when we place the trade. So for today, what I want you to do in your homework is go to CNBC. And I want you to build a watch list. CNBC.com. I want you to go to watch list at the top. It's going to ask you to sign in. If you don't have an account, create one. It's free. So you don't have to do the pro. Just create the free one. And it'll give you all of the watch lists that you've created. If you have not created one, you're going to go over here to create new. And then you're going to create a new watch list. And for us, we can do take your first trade, or you can name it whatever you want. It doesn't have it stops you on the characters. So I'll just say, take first trade. There we go. All right, and now add symbol. Oh, I did this yesterday too. I always try to check. Teachers, you got to check, make sure that what you're saying is going to make sense. So I did this yesterday, so I'll just rename this something else. So add symbol. So the first one we're going to add is SPY. And you have to put in that ticker. And it'll say here what that is. We're looking at the S&P 500. Yep, that's right. ETF, add. Okay. And in a second, we'll go and look at how this is performed. But first, let's just look at what ETFs cover each of those indexes. So we got SPY. Now let's go to the next one, the Dow. Given that, and here we can put this in here. Given that the best index for the S&P 500 was a spider index, my favorite for the other indexes are also the spider indexes. Now, that doesn't mean that they perform the best. That's just one thing that's kind of easy. But if you wanted to go and research the other ETFs, you could. So here you can click in the ETF.com and then come down and say, what are all the ETFs with exposure to the Dow index? And I think, here we go. And you know what? I think that I was talking kind of fast. I think that it actually pulled up the Dow stock I was telling you about earlier instead of the Dow index. But this is my favorite of the Dow indexes, and it's called DIA. But you all can come into here later on during your homework time, look into ETF.com, and then search for Dow indexes that cover the Dow Jones. Now, another way to find these ETFs is to actually go to the SPDR website. And SPDR, they don't spell it all the way out. They do SPDR, and I think it's sector. There we go. The website to look at all the ETFs that are in the SPDR index is sectorspider.com. You guys see it at the top here. Sector, and will someone put that in the chat for me in the Zoom and in the Facebook? Just write it out, sector SPDR.com. And it'll then show you all of the ETFs that it has that cover these indexes. So I told you one of them is the SPDR ETF, the SPY, SPY, that covers the S&P 500. For the Dow, it's DIA. And then QQQ is actually not a spider one, but I'm going to show you that one as well. For NASDAQ, my favorite one is actually not a spider ETF. It's an Invesco ETF, but it follows the NASDAQ 100. So it's QQQ. You guys got that? So let's go back to our watch list. For the S&P, we had SPY. For the Dow, we're going to add to our watch list DIA. And then for the NASDAQ, that's the technology one, we're going to add QQQ. But as I was mentioning before, the spider ETFs are really good. So if you want to actually look at what they have to offer, other than just the SPY and the DIA, put in sectorspider.com. The cool thing about the sector spiders is they also have ETFs that go for each sector. So if you see here, you can also invest in a sector of companies that are all similar. So you can invest in communication companies, consumer discretionary, energy. I'm coming down this list and skipping a couple, but financials, healthcare. So if there's a sector of the market that you're interested in, you can also choose, you know what? I don't want to do just one single stock. I'm going to invest in a sector, and then the spider ETFs for those sectors are also very good. Some of the ones that I personally like are, I like the healthcare one, XLV. So we can add that to our watch list. I need some water. There you go, healthcare. And then I like the financials. One thing you should know is when we think about financials, sometimes we think about Visa and we think about Visa, PayPal, because that's where we think about financials, but those are actually tech stocks. So when you click here into their financials, you can actually see the stocks that they include in financials. You see here on the right. So they're thinking more like brick and mortar finance companies here. Versus when you click on technology, this is where you get, and I'm going to come over a little bit, but this is where you get your Visas and PayPal. There we go. You see Visa here. So you would normally think that it's a bank, it's a financial, but no, they're thinking actually most of the time people use a website or they just swipe and then it's electronically transferred. So it's not quite the same. MasterCard is also here in technology, along with Apple. And here's PayPal here at the bottom. By the way, yesterday we talked about not investing in earnings. PayPal had their earnings, and look, they fell $43 today. Also, Facebook had earnings, they fell. So it's better not to invest in earnings, even though Google had a big jump. Also, this is definitely a side note, but another one that had a big jump was AMD. And you guys asked me yesterday, well, should I invest? No, because AMD, it jumped up today after earnings and then quickly the rest of the day came down. So you would be getting in at the highs if you get into a stock after earnings that pops up because it may fall. So just be careful of rushing in too fast. That was a random side note, but I just need to let you guys know that. Then another one over here that I like. So technologies is one that I follow often. We can add that to our watch list. XLK. Oh, hold on. It didn't go right. Delete. What's really cool is a lot of these have come down in the last few months. So you'd be getting them at really great prices. Another one that I like is XLY here. It's this consumer discretionary one. But the reason why is because oftentimes you want exposure to like Tesla that used to be really expensive, but it's come down a bit. It's actually here under consumer discretionary. So let's go over a little bit. See if we can find it. Target is in here. Here's Tesla here. See? And then another thing that's important to look at is you can see what are the highest weightings, like how much money is going towards each company. Look here, Tesla, 17% of this fund is going towards Tesla stock. So instead of investing in Tesla by itself, if you invest here in XLY, then you're still getting exposure, quite a bit of exposure to Tesla. And I wonder if it'll let me sort. There we go. Here are the highest weighted things in this ETF. Amazon, this is XLY discretionary. So for those who want to invest in Amazon, but Amazon stock itself is 3,000, you can come and invest in this stock and you get exposure to Amazon, 22%. Tesla, 17%. The next thing that they invest in is McDonald's, Nike, Home Depot, Lowe's, Starbucks. Starbucks had earnings. They didn't do too well. Target. So these are the top things that you'd be investing in if you invest in just this XLY ETF. But does it make sense how these ETFs have lots of companies in them? And when you invest in the ETF, you get exposure to all these companies. That makes sense? Here's that S&P 500 index, the SPY. And then you can see all of these companies it has exposure to. Alphabet is a big one. That's Google. AMD, Bath and Body Works. So this has 500 companies. So we'd be here for a minute getting through all of them. But what's kind of cool is you see here how some of these companies are in the S&P, but then they're also in a different sector. So this is a really cool thing to check out. You can say, okay, I do want to have exposure to Abbott. Okay, it's in the healthcare, XLV. Remember that one? The healthcare ETF. Cool. Maybe I don't want all 500 companies. I just want to go to healthcare. Or Pulte Group. Some of you guys, I would have thought that would have been in real estate, but some of you guys may like Pulte. So then you can come to consumer discretionary. For those that like real estate in the group, let's just look at some of the companies here. I know that they have this real estate. Am I pressing the real estate one? Okay. A couple of these, I'm even surprised are in real estate. Like Micron, I wouldn't have thought that was in real estate, but maybe they're considering that their major business model is not so much the product, but all the real estate they buy. I'd have to look into that. Oh no, we're still in S&P. I'm like, right, it does make sense. Yeah, let me see if I can click into, there we go. Here's real estate. I'm like, that doesn't make sense. But these are all of the stocks that are inside of the real estate ETF. Okay. So let's add a couple more of these to our watch list, and then we can check and see how they've been performing this year. So let's also add XLY for discretionary. And any other ones that y'all wanted to add? Here, tell me in the chat one more that you want to add. One more sector. We got XLK already. Okay, some people said real estate. Okay, we can do real estate. Some people said energy. Energy is good. That's where you get all the, here, I'll show you. Communications, energy. I'll show you what's in energy. And we can do it by the index weighting. So you got ExxonMobil, Chevron. If you want to invest in any of those like gas companies, this is where it'll be. Phillips 66. That's under energy, XLE. And then some people said they also wanted to do real estate. So we can add both XLE and XLRE. Perfect. All right, now we're done. So these are the companies that are in our watch list. So now let's look at their prices. So in order to invest in all those 500 companies, the current price is $457.35 per share. This is very similar to the overall index price. So if we go back to the indexes here, the S&P is 4,531 points. Sometimes they don't say dollars because the index, it just moves on its own, but basically dollars. And then you come down here, and this is very similar, almost like they just moved over a decimal, right? And then same thing for the Dow. The Dow is 35,448 points or dollars. Dollars are easier to understand. And so you come down here, and they've moved the decimal point over several places, but it's $356 is the price of this DIA Dow ETF. So what you would do, and we're going to cover this tomorrow, is if you wanted exposure to the overall market, you would buy shares of the S&P 500, and you would pay for each share, you'd pay $457. So for some of you guys, if you funded your account with $500, you might be able to just get one share of this, but that's okay because that gives you exposure to all 500 companies that are in this ETF. And as it moves, then you'll make some money. Okay. And it might go down. So you might lose some, but that's okay. The thought is that this is going to increase about 8 to 10% a year. Or you might say, you know what? I don't want to be invested in all 500. I just want to invest in those 30. So what you would do is tomorrow when we actually place the trade, you would put in this ticker symbol, DIA, and each one of those shares costs $356.03. And you can come over here and see where this has been. So in the last year, the S&P, this stock, SPY, it's ranged from 371 up to a high of over here, which is like I think this is the high. Yep, 479.98. And then this square, this triangle shows you where we are today. And y'all, I said I think, but I know that's the number. And then you got the Dow. For the Dow, the low was 304.52, and then the high was 369.50, and the triangle shows you where you are now. So we're actually not too far off the highs, even though it has felt the last couple of weeks like we have just been drowning. Like, oh my gosh, it's been falling. We're going to crash. We're really not too far off of the 52-week highs. All right. And then you got QQQ. It's the one that follows the NASDAQ 100, and it has ranged from 297.45 up to 408. It's the one that's off its highs the most. So it's down here at 368.49. So tomorrow, if you said, you know what, I just want to have exposure to those 100 technology companies, the one that I want to invest in is QQQ, then you would pay $368.49 per share. All right. And then these are the prices for those sectors, those sector spiders. So remember, if you wanted to be exposed to healthcare, then you would invest in this one tomorrow, and it's $133. So if you had put $500 in that account, you could invest in 3 of these. I would say 4, but you'd be pushing it over a little bit. And then you all can look at the rest. XLK, the technology sector, is $163 right now. The consumer discretionary is $184. Energy, $68. And then real estate, $47. Okay. Cool. Now, someone was asking, what's the difference between a mutual fund and an ETF? An ETF you can trade like a stock. So it has charts, you can get in and out of it. And mutual funds you can also invest in, but usually if you're looking to be a trader and like get in and out of something, you use the ETF. It's treated like a stock. Okay. All right, so now we know where this is. Now let's look at, we don't have to stay on super long. I can stop and answer questions today. But real quick, I do want to look at where this has been over time. So we saw the highs and lows, but this is what this has looked like in the last year. And this is the S&P 500. So in February of last year, we were down here. If you see this chart, let me make this bigger. We were way down here in February of last year. And then throughout the year, it rose to here. That's what they mean when they say that it was up 26.9%. And our hope is that this year we're starting out low down here at 43, down here. And that over this year, it'll also increase. But look at where this has been the last 5 years. You guys see that? Over the last 5 years, the S&P has gone pretty consistently up. There's been some blips, of course. Look at this. So it's gone consistently up. But of course, there was a blip in 2020. That was for COVID, but then it consistently rose again. So the reason why I cover that is this is a safer stock. And if you all are taking your first trade, I think this is one that you will be like a soft landing. This one would be one that would be kind of easy to put into your portfolio, easy for you all to even hold. Like if you want to be a long-term investor, you could also keep this because the S&P usually goes up every year. So this is a great way for you to get started with investing. Now, what's the difference between investing in this and what I do? If you're investing in the S&P 500 and you just kind of let that go for a while, you will have good returns, but you'll have good returns over a year of time. It moves quite a bit, but it doesn't move a ton on a day-to-day basis. But if you're trading, what you would do is you would say, you know what? Instead of just staying in this all day or all year, when it comes up, I'm going to sell some. When it comes back down, I'll get back in at a lower price. And you can trade in and out of S&P to make more than 8 to 10% returns. I have some of my students who are on the call and they focus on SPY. They just trade in and out of it on a regular basis and they make more than 8 to 10%. So that would be the difference there between like long-term, just holding this or trading it. Okay. Let's look at where the Dow has been over time. Most of the time, the Dow and the S&P's charts look very similar. They trade together. So you remember yesterday when I gave you that gem of in your watch list, put things together that move similar? That these two would be right next to each other in my watch list at all times. Because if the S&P is moving, then the Dow is. If the Dow is moving, the S&P is moving. Side note, extra gem, as a trader, the Dow tends to move first. So if you're trading, I would be a trader of the S&P, but I would watch what the Dow was doing. What do I mean? So if the Dow is down 300 points and the S&P is still green, it's very likely at some point the S&P is going to start turning and going red to match the Dow. Or if the Dow starts slowly ticking up and the S&P hasn't moved yet, it's likely that as the Dow moves up, the S&P will move up after. So if you're a trader and you're trying to trade indexes, I would trade the S&P because you can watch the Dow to see what's going to happen to the S&P. Random gem, but it's important. It just gives you an extra edge. Okay. Now let's look at the Dow. So this is what the Dow's chart has looked like. You don't need to know all the squigglies. You just need to know that from March of last year, it was down here with a low. We saw this yesterday inside the box with the open and closement. The low on this was $308. And then now you can see today in this green box, it's at $355. So over the year, this has gone consistently up. It's got, some ups and downs, ebbs and flows in there, but this is a good soft landing for where you all invest at first. And even over 5 years, this is what that chart has looked like. So have I made myself clear? Put clear in the chat if I've made myself clear on which companies you can invest in to invest in the overall indexes and why this could be a good company for you to invest in. Like this is why we're focusing on the overall ETFs of the market during this challenge versus trying to pick a certain company. If I'm trying to get you out to take your first trade, it's good to take it with a really healthy index ETF. Let me look at the chat. Put clear in the chat if you're clear. Okay, good. I'm saying clear. You're welcome. Someone said thank you. Crystal clear. Good. Perfect. All right. I'm going to take 10 minutes of questions and we'll stop here today because I think this is a big thing, even though it seems small. Okay. Deidre said not clear. Deidre, ask your question. So let me stop here so that I can answer the questions of those that are not clear. Good. Olu says, nah, this is huge. Thank you. So yes, if you want to invest in the overall market, those NASDAQ, S&P, or DOW, you have to use an ETF unless you're trading options. But for us, we're doing stocks and ETF. The ETFs that we have chosen are these here in the watch list: SPY, DIA, and QQQ for the overall market. And then if you still have some money left when you're investing tomorrow, you may want to pick a sector to invest in. And we found these ETFs that cover sectors. Okay. All right. Now let me answer some questions in the Q&A.